Everything you're about to hear is for education and entertainment purposes only. Whilst we are licensed, we're not aware of your personal financial circumstances. Any advice is general advice. Equity Mates operates under Australian Financial Services Licence 540697.
Equity Mates!
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Equity.
Welcome to another episode of Equity Mates, a podcast where we explore what's possible in the world of investing. If you've just joined us for the first time, a huge welcome. My name is Bryce, and today we're looking at the opportunities that exist outside of the ASX top 20. To chat through it, as always, is my equity buddy, Ren. How are you?
I'm very good, Bryce. Very excited for this episode. If you love banks and miners, turn off this episode. Go listen to another one, because this episode is not for you.
No.
For too long, the Aussie market has been seen as just banks and miners. But there's plenty of interesting companies out there.
There are.
And the expert we're speaking to today is trying to invest in the ASX 200 or ASX 300, except the top 20.
Yes. Filtering out those 7 companies that dominate the top of the market.
The 7 being 4 banks.
Yep.
And then, let's name them.
Yeah,
Commonwealth Bank, ANZ, Westpac, and NAB.
Yeah.
The 4 major banks, and then the 3 major miners,
yep.
BHP, Rio, and Fortescue.
Yeah. So what opportunities exist outside of that? We're about to find out. We're bringing in Dion Hershan. He is the Executive Chairman and Head of Australian Equities at Yarra Capital Management. They run an X20 Aussie equities fund. So we're looking forward to finding out about what he is looking at and the opportunities that, as I said, exist outside of those big, not only just those top 7, but they make up such an incredible percentage of the ASX. So,
We asked Dion to bring a couple of companies to sort of do a bit of a deep dive on some of his tomorrow's blue chips, which was a term that we read as we were researching for this episode. So we're going to do a deep dive on 2 stocks in this conversation as well. So let's get to our conversation with Dion. As we do, we want to say a massive thank you to Yarra Capital Management for sponsoring this episode. Their support helps make all of our content free for everyone. So a massive thank you. Let's get to it.
So Dion, welcome to Equity Mates.
Thanks for the opportunity to have a chat today, Bryce.
When we were preparing for this, you said that you wanted to talk about why the market today is very different to the ASX of old. So it's a pretty compelling place to start today's conversation. Let's start with the ASX of old. What was it characterised by?
Yes, the ASX 200, I'll start by saying that is the default benchmark which most institutional and retail investors think about as they invest. And if you go into a passive fund, obviously, by definition, that's what you're buying, and a lot of active funds are benchmarked or closely tied to what the benchmark is. Look, what I would say, though, is for extended periods of time, the growth of the Australian economy was driven by the resources sector. In particular, it was driven by bulk resources such as iron ore, coal, which we'll talk about in a moment, don't have the same future as we believe they did have in the past. We're also driven by the extraordinary success of the Australian banking system, which decades ago was the envy of the world, high returns, really significant credit growth. So in some respects, the 2 barbells of the Australian market were helping to generate really strong returns. And Australia's always had a good scattering of quality industrial companies, consumer-oriented companies, I should say, and a significant amount of REITs. So I think if you look at the benchmark weights, you'd probably say they're not vastly different to what they were in the past if you compare sectors. So starting point today is about 20% of our market is banks, and about 15% of our market is 3 major diversified mining companies, which largely produce iron ore. I'm referring to BHP, Rio and Fortescue, obviously. So what I'd say is it's slightly more concentrated than it has been in the past. But it's more focused on 2 industries where we think the future looks significantly harder than prior decades. We'll talk more about what we think is going to happen with banks, what we think is going to happen with the bulk commodity sector going forward.
Yeah, I mean, that rings true with, I guess, my perception of the ASX when I started investing. It was banks and miners. That seems to be the catch cry. So tell us a bit about how the ASX is changing and, sort of what it looks like today, especially outside those bigger companies?
Yeah, so if you put those two sectors to the side, which are often referred to as the barbells, I think what you'd find is it's been thinned out in the middle. And the obvious conclusion to draw here is to look at how many IPOs we're seeing versus how many take-privates we're seeing. So 2021, from memory, had about 30 IPOs in Australia above $50 million. Last year had one. So what we're seeing here is the IPO market is becoming increasingly difficult for a few sort of contributing factors, one of which is there's more equity in private markets than ever before. The friction associated with being a public company is higher than there ever has been before. So companies, the phrase that's often used is companies are staying private for longer or private forever. So what you're seeing is a dearth of sort of new issuance, in particular because there's either an issue around the quality of businesses that have tried to go public or the valuation expectations of businesses that have tried to go public. Whilst there's a constant influx of acquisition targets in the Australian market. So, look, the last time I looked at the data, we've probably had 10 or 15 times the amount of dollar value stocks taken off the exchange than stocks put on the exchange. So if you think about that, that's one of the things that is concentrating further the barbells and concentrating further the benchmark. So the way we think about it is you have to look harder, you have to reach further, you have to research businesses that are a bit less obvious to find superior returns. So that's one of the distinct ways the markets have changed. Another way that the markets have changed, and you could argue it will make them more inefficient in the future, is more and more of the money being invested is passive. And more of the money is quant, and a lot more of it's actually retail. So institutional investors that do research and then make long-term decisions, I'd characterise them now as being the distinct minority. I'm familiar with some data in the US. I haven't seen the equivalent data in Australia, but what it speaks to is 40 to 50% of trades on the NYSE are passive trades, and less than a quarter of the trades are what you'd refer to as fundamental institutional investors. So as you can see these two things happen, you see a market which is shrinking in the middle, as I described. You see a market where liquidity's actually been dropping, which is a bit counterintuitive when the markets are at sort of all-time high in Australia. And you've seen what we'll call sort of the thinning out or net shrinkage of the quantity, the quality and the quantity of major companies.
Wow. I guess then, do you still then find any part of the ASX compelling?
Yeah, look, I don't want to sound too pessimistic. Yeah, we absolutely do. I guess my observations is you've got to flip more rocks. You've got to look in different places. You've often got to look with different time frames. And I'm going to sound somewhat old-fashioned here, but we think long-term returns can be traced back to growing earnings and cash flow. So, dividends are nice along the way, and dividends have been a really important feature of the Australian market. But if you haven't got growth in earnings and cash flow, it's going to be really hard to create capital returns. So it's with that in mind, we think that the superior growth actually comes outside of the big seven companies, which we often refer to quite cynically as if the US has got the Magnificent Seven, we feel like we've got the Mundane Seven because they're not growing, they're not particularly exciting. But we feel the superior returns are probably outside the big seven, or they're outside the 20 biggest companies.
I've never heard the Mundane Seven before, but I like it because earlier today we were speaking about the Magnificent 11 now over in Europe, the granolas. So they've got the 11, US has the Magnificent 7, we've got the Mundane 7.
Yeah.
And it's just an observation because you read a lot about how narrow the US market has actually become and how concentrated around the seven biggest companies. But very rarely do people do a point-to-point comparison. The seven biggest companies, when we looked at it recently, were 29% of the S&P 500. Again, they're the Magnificent Sevens. Those seven stocks, by the way, over the next 3 years are projected to have about 30% growth per year in earnings. Again, higher valuations, but earnings driving up the Magnificent Seven and the S&P 500. Let's contrast that for a second with the seven biggest companies in Australia, as I define them, which are the major banks and the three major miners. Those seven companies are in fact 34% of our market. So we have a more concentrated market than the S&P 500. And what is sort of disappointing or dismal is, according to consensus numbers, there's basically no earnings growth for the next 3 years.
Yeah, wow.
So now you can find other factors at play, and you can believe consensus numbers might be wrong, but it's a pretty different starting point vis-a-vis the US.
So then let's get outside the top 20, and Yarra Capital has a ASX X20 fund. So tell us about the names outside of the X20, and I guess maybe compare and contrast what's going on with the mundane top end of town with the bit more exciting middle part of the index.
If you look at the middle part of the index, what you find is typically you still find quality companies. They don't have the failure rate or the imprecision associated with sort of risky small caps and micro caps. There's a place for investing in those businesses. But by the time you get to be a mid-cap company, it's fair to say you've got a proven business model, you've probably got a proven management team, and you've probably got reasonably solid growth. Once you look outside the 20, I think it's interesting. When you are the biggest companies in Australia, you tend to be either domestically facing and you're hostage to what the Australian economy does. You know, you're more of a macro play often than a micro play. If you're a global resource company, you're obviously really dependent on what's happening with China or what's happening with global commodity markets. So the larger you get, by definition, you become more macro-oriented as a company. Think about BHP, ANZ by way of example. Once you move out of the 20, I think what's more exciting is there are micro opportunities. There are businesses that are growing new markets, businesses that are taking market share, and they're not hostage to what's happening with GDP numbers and inflation numbers and global industrial production. So it lends itself to, in our opinion, superior stock picking. And you've also got the added advantage when you move outside the 20 is you just don't have this concentration of the benchmark. Like the top 7 positions outside the 20 would be less than 10% of the benchmark versus being 34%, as I described before. And you've also got companies that are far less efficient. You know, if you looked at BHP, from memory, you've got over 25 global sell-side analysts covering it. You look at companies 21, 20, 22, 23, you've got less than half of that level of coverage. So from our perspective, it speaks to greater inefficiencies. It speaks to companies that are still proven quality businesses. But in the same way that I shared earlier, we think the 20 biggest companies have got only modest growth. The top 7 have got no earnings growth for the next 3 years. Once you move outside the 20, consensus earnings growth is about 8% for the next 3 years. So our view is you've got superior choice, you've got quality businesses, and you've probably got superior growth in earnings, which we think leads to cash flow, leads to dividends, leads to shareholder returns.
And so just to be clear, when you're approaching the fund, the X20, are you still sort of staying in that ASX 200, 300 or really looking at the total addressable market outside of the top 20?
Look, we tend to gravitate towards the 200 or 300 biggest companies. It's where we can get the liquidity. It's where we can get access to the information that's necessary for us to make decisions. And, you know, in some respects, we've got great choices to make inside that universe, so we don't feel the need to reach further.
Yeah.
So a little bit later in this conversation, we're going to dive into 2 companies outside the top 20 that you find compelling. Before we get to the specific stocks, I guess we want to understand a bit more about your investment philosophy and your investment process at Yarra Capital. So can you, first of all, talk about your philosophy, what you're looking for, and then your process, how you're finding it?
The team that we have over a dozen people who work in our Australian equities business, have been working together for, most of the team's been in place for 15 years, and it's a very sort of collegiate effort. But our philosophy is the greatest inefficiencies exist over the long term, not over the short term. Philosophy relies upon the fact if you analyse and research businesses extensively, you can make, we believe, quite accurate long-term predictions, but often not accurate short-term predictions. So our view is we're long-term, we're very fundamental. Like we're trying to get to know businesses, management teams, industry structures, very detailed financial analysis. We're also really a style-neutral investor. A lot of people talk about growth or value. Our approach is let's just maximise the opportunity set. Let's just make sure everything's in the pot and we can sort through and be really, really selective and find the right companies. And the other key tenet of who we are is we like to think we do the boring things well. And the boring thing is like portfolio construction, risk management, making sure we have appropriate balance, because you don't want to be defined by 1 or 2 stock ideas. You want to have a high degree of discipline and balance in your portfolios, because that's how you get sort of enduring performance for your clients.
So you mentioned at the top, Dion, that there's a large amount of passive investing going on, only continuing to grow year on year. And a lot of the Equity Mates community are naturally heavily weighted towards the ASX 20, given that we are, dollar cost averaging into index funds. So how might an X20 fund complement this strategy? How should we be thinking about this in terms of our own portfolios?
Yeah, so I guess let's start with the early part of your question, which is, a lot of people are going into passive funds and ASX 200 funds. If people only remember one statistic from this conversation, and they probably won't remember one because I'm sure it hasn't been that interesting, but it's that $1 in $3 in a passive fund is going into a bank or an iron ore miner. So just think about that for a second. It's a subconscious decision that people are making. $1 in $3 is going to the big four banks or one of the three major miners of every passive dollar. And that may have served people well in the past. We don't think it will serve them well into the future. So to get to the heart of your question, if you're going outside the 20, what are you getting? You're getting a much better representation of tech stocks, healthcare stocks. You're getting a more diversified benchmark where no stock is more than 2.5% of your market versus being BHP being or CBA being 10 or 10% plus of the benchmark. You're getting superior growth. You're getting superior choice. And you've got, let me pull apart different sectors for a second by way of illustration. So if you're looking at the large cap resources market, it's dominated by iron ore because it's such a big commodity. It's Australia's largest export. Nothing else matters. Once you start to look outside the 20, what you'd probably see is you've got great choice. You've got copper, you've got mineral sands, you've got lithium, you've got rare earths, you've got meaningful gas businesses. And that choice is something that we value. And through time, I think that's how we create value, by not just choosing the right companies to own, but avoiding the things that we think will be problematic in the future.
Let's illustrate what we've spoken about with a couple of examples. I think we were reading an article you wrote where you spoke about looking for tomorrow's blue chips, which is a phrase we quite like, so we might steal it from you. But you've given us two companies, Car Sales, the ticker is CAR, and NextDC, NXT. So let's start with Car Sales. I think people are probably pretty familiar with the brand, and they've seen it advertised. They probably looked for cars on it. But tell us about what the company does and the business, how it makes money and all of that stuff. And then let's talk about the investment thesis and go on from there.
Yeah, so let's start with sort of the definition of blue chips because it means different things to different people. So in the past, people refer to blue chips as things that are big, they're solid, they are enduring, they're household names as such. But I think in many respects that speaks to the past and not the future. I'd remind people that AMP was one of the largest companies in Australia. It was a blue chip name. The last time I checked, it was a small cap, or was about to be reclassified as a small cap, right? So we want people to question the status quo. Some of the biggest companies in Australia did not prove to be enduring franchises. So look, for us, as we think about a future blue chip, you want businesses that have got a dominant or semi-dominant market position. You want businesses that have got meaningful growth. You want high returns, because that leads to the capacity to reinvest. And you want businesses that are well managed. So for us, that's probably what we're looking at in the future as we sort of tag something and say this could be a household name, this could be a business that's a lot bigger than it actually is today. And what's great about looking outside the 20s, you can find some interesting businesses that are probably not that well researched that can still, in our opinion, double or triple. So Alec, your point was well made that a lot of people are familiar with Car Sales to a point where a lot of people actually thought the business was mature. 5 years ago or 7 years ago, people said, look, it's already got every car listed in Australia. How do you actually see growth? By way of example, in the last 5 years, Car Sales has more than doubled its earnings. And we think there's foundation to more than double again in probably over the coming decade, maybe not the next 5 years. So when you pull apart Car Sales, it's easier to think about it in terms of a domestic franchise, which is dominant. There is no reasonable alternative to using Car Sales for used cars. And what you'd find is they've probably got 90% plus market share. There's a lot of value in use for customers, whether or not you're trading in a car or whether or not you're selling it privately. What they charge their customers is a very small proportion of what the cars actually sell for. It's referred to as a low take rate. And you want businesses that can continue to take more and more over time, whilst there's still value in it for everyone else in the value chain. And we think that's absolutely the case for Car Sales. So what you've got here is a business where the number of used cars in Australia probably grows quite modestly. But the value of cars has tended to go up in recent years. What you've also found is there's a lot more sort of value and use in the product, and it's gone from just being listings to now being car checks to now being tyres to possibly being payments in the future. And you also find with these marketplaces is prominence becomes more important. So when you've got 200,000 cars on the website, some people are willing to pay more to make their car more visible, which leads to higher prices, higher margins. So what we see with car sales is they've got a proven business model in Australia. It's miles away from being mature, in our opinion. And we also start with the view that very few Australian companies have grown offshore successfully. You know, we often say there's a graveyard full of Australian companies that tried to export their IP. The ones that tend to do it well are the ones that have got genuine points of difference, the ones that do it in a slow and measured way, often the ones that do it using local management teams in those countries rather than imposing Australian management teams or Australian values. And I think what we'd say is that car sales and stage manage that very, very well. Half their value is now businesses outside of Australia. They've got a strong presence in the US, which is not for vehicles, it's for non-vehicles. It could be RVs, it could be water sports, I should say non-cars rather than non-vehicles. And they've also done it in Korea and they've done it in Brazil. So you've got a strong management team, dominant market position, plenty of runway to growth. Earnings have doubled in the last 5 years. We think there's significant growth in the future, and we don't see any real signs of maturity.
I guess on the flip side then, what will you be looking out for? You mentioned the risks of international expansion, and a lot of money can go into trying to grow businesses offshore, and we've seen it here time and time again. Strategic decisions to stop overseas expansion because it's just sucking up so much capital. So what are the risks that you look at when you're thinking about the next 5 or 10 years for car sales?
We would probably say the biggest risk is left field competition. The traditional competitors, whether it's Gumtree or Cars Guide, have tried valiantly for extended periods of time and frankly haven't left a dent. But there be a left field competitor? It could be through social media, it could be through Google. I know it's an overused term, but it could be enabled via AI, something that would challenge the incumbent. I think car sales has got a healthier degree of paranoia around how they run their business. So they're not complacent about it, but to me that would be the most substantial risk. There's not a lot of economic sensitivity in the business. So apart from sort of management missteps, that's the one that I've spent a lot of time thinking about.
It's a pretty amazing story. I'm just looking at the share price, up 50% in the past 12 months, up 11% already this year. It just keeps growing. Yeah, you're right. It is a business that I thought was kind of fully cooked when a couple of years ago. But yeah, it's just, it's amazing how wrong you can be.
I've been in this business too long, obviously, but I still remember people debating it being mature at the IPO and whether or not there was any scope for growth. And if you trace that chart back, it's probably been a 10-bagger since the IPO.
Wow, I love that. I love it's a lesson that I learn over and over again, that companies with good management teams can keep growing for a lot longer than you think. And I think that leads to the final question, which is for car sales in 10 years from now, if it is able to properly execute and, it continues to be run well, what does it look like?
Well, look, I'd say you've got a substantially bigger Australian business that in 10 years' time would have to be closer to being mature. There'll be in different parts of the value chain. You'd like to think they've taken the IP and the playbook that worked in Australia and customised it, and it works in the other 3 geographies. They have a meaningful presence. But I also think they will have, if that works, they've earned the right to grow. And there are so many other countries in the world where auto marketplaces are less sophisticated and less developed than they are in Australia. And I would have thought they would have built a beachhead or a presence in more countries than they're currently in today, which again speaks to longer-term growth.
Will it be an ASX top 20?
Yeah. Look, it's absolutely conceivable. I mean, the starting point is $13 billion of market cap. If you're going to keep doubling your earnings over time, it's absolutely got scope to be inside the 20.
On that point, how does the rules of your fund work? Obviously we've got some pretty boring companies in the top 20, but WiseTech has just, I'm pretty sure, got into the top 20.
It's about to get into the ASX 50.
Oh, sorry. No, sorry.
So there's always a lag with the index.
Who am I thinking? Am I thinking of REA? REA's got itself into the top 20?
It's just out.
Just out?
Market cap.
Okay.
I don't believe it's
21.
There's not a lot of free. There's a lot of free floats.
Okay.
A lot of free floats.
So Santos is at 20 right now at 26 billion market cap.
That doesn't really prove our point. So when REA gets into the top 20, assuming it will, or let's say car sales in 7 years gets into the top 20, do you have to sell them?
We're not forced to sell immediately. We're trying to balance two things, which is always trying to do the right thing by the customer, but also having sort of truth in labelling. We are, that fund is an X20 fund. So what we find is we probably hold things for 12 to 18 months, and then we'll, hopefully new ideas arise where we can sort of compound capital over time.
Fair enough. Well, let's move to a second company that is in your fund and has potential to be one of tomorrow's blue chips. NextDC, NXT, probably less well known for a lot of people. It's not as consumer facing, obviously. So tell us about the company.
Yeah, sure. So I know this probably sounds fashionable to be talking about data centres and AI now, but this is an investment our team's had for the better part of a decade, and it's been very kind to our investors. Look, start with a few really obvious facts that more and more data is actually moving to the cloud. And it's gone from people having data centres in-house or data effectively on your laptop at home towards more secure and aggregated centres such as data centres. So you've seen an enormous amount of migration towards data centres. Now that is by no means over. On many estimates, the majority of data is still outside of large-scale data centres. So we think there's a ton of growth that will still happen through that front. The second thing, and I think we're all a living case study of this, is our data consumption is just going up exponentially. Whether or not it's your Netflix or your phone or what you're doing at work, we're probably seeing 40 to 50% like-for-like growth in data consumption. And the third thing, and again, it sounds fashionable, but it also appears to be real in the medium to long term, is once you add AI into the mix, data consumption just goes absolutely vertical. And, there's many instances where it's starting to be used, and you can see just how thirsty it is for data. So we think the data centre industry has probably got the highest growth, or amongst the highest growth we could see in the tech landscape for the Australian market. We'd also point to the fact that NextDC is a quality operator, blue chip clients, happens to be the only meaningful listed data centre operator in Australia. There are a few overseas that are also worth mentioning. But it's a well-run company. And once you've built a data centre, you've got a lot of stickiness amongst your clients. A lot's got to go wrong for them to leave. You don't take that for granted. So what you're effectively creating is infrastructure with a really high degree of persistency, good pricing power, cost contained. And the attributes for these businesses at maturity look a lot actually like toll roads. And we think that makes them really attractive assets to have over time. But, toll roads aren't growing at 30, 50, 100% a year like some of these data centre operators are today.
Just on that, for me, it feels like an industry that if you've got some deep pockets, it's something that you want to kind of get into. So what's the competitive advantage that they really hold here against someone that's just going to come in and go, we're going to take market share here in Australia and go out and build new infrastructure to take over?
Yeah, it's a fair observation. I guess the way we've always thought about it, and this is I think there was a bit of misstep for other people who addressed it, is it's not winner takes all, because the demand is actually growing so quickly. What you're finding is the Googles, the Microsofts are building both their own data centres in Australia, but for redundancies and to make sure they can support growth, they're using third-party providers such as NextDC.
Right.
So the rate-limiting factor in this industry, frankly, is not demand. The rate-limiting factor is how fast you can build and certify these sheds. So you might say in the first instance, well, how hard could it be to put a few pieces of concrete together? The scarce resource here is your ability to permit, to certify, to win new major clients and to win their trust, to onboard them and to manage them. And that's the complicated part. And that's why, both the barriers to entry are high in our opinion, but the barriers to success are equally high.
So I guess when you're building your investment thesis and you're thinking about the risks, what are some of, I guess, the particular risks around NextDC as a company? Obviously, maybe AI falls off and we realise that there was a bit too much hype, but I guess more like idiosyncratic company-specific risks with NextDC.
Look, the one that we're the most focused on is some form of a cyber breach. Well, let's start a meaningful cyber breach where they're found to be negligent. I don't think that will be the case, but it's a left field event you have to consider. Look, making a long-term outsourcing decision to a data centre operator such as NextDC relies really heavily on trust and credibility. So it's things that could break that trust, which would create sort of an air pocket for new wins or possibly encourage clients to leave existing data centres. Again, we think it's a left field event, but it's something we've got to be alert to.
This is a frustrating company for us because I remember we were talking about it on the podcast back in 2019 when the share price was about $5.50.
What's it at now?
1680,
Okay.
1687. And we made no movement on putting it in the portfolio, but it's been some phenomenal growth.
Yeah, Dion, it's NextDC, and the other one is Ordinate, which we've spoken about for years and never bought, and just watch it just rip. Anyway.
So when you think about this over the next 10 years, like how big do you see NextDC getting?
Yeah, we can sort of start with a few simple facts, which is they've got about 150 megawatts is the relevant metric of consumption. So they've got about 150 megawatts that they've currently sold to clients, and that's more than doubled in the last 5 years. But they've actually got pretty close to 1,000 megawatts in planning.
Right.
Now, as I said, this is an industry we don't think demand's an immediate constraint. It's actually supply. You know, the megawatts they've got on stream are supposed to come through probably the next 5 to 7 years. So if they can deliver into that potential, you've got a business that can 5x its volume in possibly 5, 7, 10 years, which is very rare in the Australian market. And because there's a fixed cost associated with running the business, your profits would grow a lot faster than the volume they're actually serving. This is where I think, we get a lot of things wrong, by the way, so I don't want to sound like we always get it right for a second. But where a lot of people have been too short-sighted on NextDC is they've looked at what's happening in the next 12 months, what's the PE, what's the EBITDA ratio. And for long-cycle businesses with a high degree of visibility, you're always going to get it wrong if you're only looking 5 minutes ahead.
Wow. Well, a lot of opportunity, and I'm interested to see how the top 20 changes over the next decade or so as a lot of these emerging tech companies in Australia continue to get bigger and bigger. We've seen WiseTech make it up there, as Red said, and Xero's getting up there. Afterpay was up there at some point or close to it. So, it's interesting. But we have reached the end of our time today, Dion, so thank you so much for taking the time with us. I know a lot of our community would have taken a lot out of that. If you are interested in the funds we've been speaking about, head to the Yarra Capital Management website. We'll include a link in the show notes. You can find more about the X20 fund that we've been speaking about, plus the other Aussie Equities funds available. But Dion, thank you so much. It's been an absolute pleasure.
Pleasure. Thanks for your time today, guys.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.